Go.
In this really, really tough and competitive spring market where there's quite a bit of competition and offers being put on at home, we have several buyers who have asked us, how can I buy another home without first having to sell my home? So in this presentation today, we are going to talk about some strategies for that. And my name is Leslie Wish, loan officer here at the Wish team.
And my name is Richard Fiegel. I'm Leslie's loan partner, also a loan officer on the Wish team. So the first thing we'll want to talk about is minimum credit score requirements for obtaining a new mortgage. So contrary to popular belief, you don't have to have an 800 credit score in order to get a mortgage. The minimum credit score requirement across all of the loan programs that we offer is going to be a 620. Now, the mid-range tier that you see listed, 700 to 720, that would put you in kind of the middle of the road in terms of the interest rates and loan terms that you'd be able to qualify for. But a credit score of 760 or above would put you in the top tier and help you to qualify for the best interest rates and terms available. Next, we'll talk about minimum down payment requirements. So for depending on the occupancy type of the property, if you're looking at a new primary residence, you'd be looking at a minimum down payment requirement of 5%. For a second home purchase, you'd be looking at a minimum down payment requirement of 10%. And then for an investment property, you'd be looking at a minimum down payment requirement of 20% or more. In terms of where that down payment can come from, there's multiple different sources that you could pull from. The most common is going to be using your personal liquid accounts, such as your checking and your savings account. Some of the other less known options that you can use to come together with your down payment would be a gift from a blood relative. So that is allowed. You can receive a gift from a family member, and there are specific steps that you'll want to take to make sure that is all done above board, and you'll want to speak with your loan officer team, Leslie and myself, to make sure that is done in the proper manner. Next option would be borrowing from a retirement account. A lot of people don't realize you can do that. If you have a TSP loan or maybe a 401k account, you can take loans against those assets. You want to speak to your plan administrator to make sure you understand the terms and how much exactly you can borrow from those accounts, but that is an option that you have available to you. Typically, it'll take about 10 to 14 days to receive the funds from either one of the loans from those accounts, so you'll want to make sure that that's all factored in terms of when you'd like to close on a new home purchase. Another option would be taking a margin loan against the assets. So this wouldn't necessarily be retirement assets, but maybe you have investment accounts with a brokerage. Speaking with your advisor would be a great first step, but in some cases you can borrow from those assets or take a margin loan against those for your down payment. And then two other options, which we'll be going into a little more depth today, are going to be the home equity line of credit and the bridge loan. Typically the bridge loan and the home equity line of credit, those two terms are going to be more or less interchangeable. More commonly, you'll be looking at using a home equity line of credit, which will allow you to access some of the equity you have in your current home to bridge the gap between any funds you might need to purchase that new home. I'll let Leslie take it away with talking a little bit more about HELOCs.
Great, thanks, Richard. So one of the first things that you're going to need to consider before you can really come up with a strategy is to meet with a realtor to determine the potential list price of your home. You're going to want to have a good idea of what that is. So that's why it would be very important to get that number ahead of time. And if you don't already have a realtor, we have some great real estate agents that we work with, and we'd be happy to make a referral to one of those for you. The next step would be to submit a mortgage loan application. So this would be an application to get loan pre-approval completed. And the reason that this is really important is because you don't want to start moving forward, listing your home and getting everything in the works without knowing that you can qualify for the strategy on which we are trying to help you with, which is buying a home before you actually sell your current home. So we'll want to make sure that you're going to be able to carry all of the mortgage payments that would be associated with this. Documents that typically the lender wants to see as part of the pre-approval would be your income and asset documentation, meaning your pay statements, W-2s, if you're self-employed, your tax returns, asset statements, which would be your, checking savings accounts, just money that you have liquid, and your retirement accounts possibly. And then the mortgage statement, tax bill, homeowners insurance policy, and association dues, these all apply to the home you're living in now. So because we would be looking at you carrying that home while you, at the same time you would be purchasing a new home, we have to factor in all of the expenses for your current home as part of the debt to income ratio calculation that we will be doing for you. So we'll be asking for those documents as well. So what is a HELOC? HELOC stands for Home Equity Line of Credit. And basically it's a line of credit against the equity in your home. So, everybody's going to have differing amounts of equity in their home. And we would need to determine how much of that equity you would need to be able to access in order to move forward with the strategy of purchasing another home. So one of the things we'll be doing as part of your pre-approval is helping you determine that. And then also helping you to take the next step to getting that home equity line of credit in place, depending on how big of a line you would need and how much equity you have actually available to you in your home. So another important thing to note is the interest rate on these equity loans is variable. That just means it can change from month to month because it is based on the prime interest rate. So when you hear on the news that the Fed is moving interest rates upward or downward, that ultimately filters into the prime interest rate, which ultimately filters into the rate you would be paying. So there is an actual formula that lenders use to determine what interest rate you would get on the home equity loan. And that's usually the prime rate plus a certain margin, 0.25%, 0.5, or 1%. So that all depends on the amount of equity you're taking from the home, as well as your credit score and a few other factors. The payments on these loans, you can make interest-only payments. That helps to keep the payments a little bit lower. And you can always choose to pay principal and interest as well. So that's going to be up to you. But the idea of this is you're not going to be holding this equity loan very long if you're looking to move into another primary residence and sell your current home. Eventually that loan will end up being paid off, and hopefully it won't take too long to have that happen. So with the home equity line of credits, the time frame to get those in place is typically about 3 to 4 weeks. And usually there are lenders out there that we work with that we can help you, in-house through our processes, or outside lenders that will allow you to take up to 90% of the equity from your home. So once you subtract out your current mortgage balance and determine what equity is left, that's where you come up with the percentage of equity that you can take out. The more equity you take out of the home, the higher the interest rate, and vice versa. We already talked about the interest rate being variable, so that can change from month to month. And there will be closing costs associated with this loan, although not nearly as high as you would see if you were purchasing a new home. So the typical closing costs, depending on your loan amounts and so forth, are going to range anywhere from probably about $1,200 to about $3,000. Prepayment penalties, you typically do not see the prepayment penalties on these loans, but each lender is going to have their own rules. So we will want to help you check that out up front to make sure that there is not going to be a prepayment penalty for paying off the loan earlier than a certain determined amount of time.
All right, so a couple things to consider when looking at purchasing a property before selling your current home. So as Leslie was mentioning, taking a look at your potential net proceeds from the sale of the property is going to be of great importance for calculation of the HELOC. You're going to want to do a calculation to see how much equity you have in the property, considering the limits on how much you can borrow of that equity, but also considering once that home does sell, how much you would potentially be netting from the sale of the property will help you to have an idea of how much that you may potentially have left over after paying off the potential equity line, as well as your current mortgage that you have. Now, one question a lot of people ask is what happens if your home does not sell immediately? Well, simply put, if you've taken out a home equity line of credit, then you'll still have to carry those payments on both the home equity line of credit as well as your main mortgage that you have on the property. So it is something to consider, taking a look at those combined payments and making sure that you're comfortable with the idea of making those payments on the old property and the new property until your current home sells. Now, when your current home sells, the home equity line of credit loan as well as the main mortgage, they're both going to be paid off. So any surplus that you have, you can use to pay yourself back for any personal funds that you might have used to help facilitate the transaction. And additionally, one option that you might have, depending on how much additional funds you have left over, is recasting the loan. So essentially, a recast is going to be a restructuring of the mortgage on the new property based off any large principal reduction that you might pay after closing on your current home. So it would recalculate your monthly payment after the fact. A couple other important things to note. Please do not list your home without first speaking to your mortgage lender. You'll want to make sure that if you are looking to utilize some of the equity in your property, that number one, we make sure that you can qualify holding those additional payments on said loan. And additionally, a lot of times the home equity line of credit lenders are not going to be able to offer you the loan if your home is currently listed. So please do first talk with us about that. Additionally, please do not apply for any 401k loans, as well as the HELOC, as we just mentioned, without first being pre-approved, so that we make sure that any applicable payments that you might have to cover, you qualify with those payments and the new home loan payment. The third point there, please don't pay off or close out any credit cards or installment loans without first talking to us. What a lot of people don't realize is that a large portion of your credit score is going to be based off of your payment history. So if you close out any accounts, that could actually work against you and hurt your credit score as you're wiping out that good payment history. So something to discuss with us before taking any action there. And then lastly, in terms of any liquid funds, please don't make any large cash deposits into any accounts. People will run into issues with that. And mortgage lending, we do have to source any large deposits that are put into an account. So if you have a large amount of money, what they call mattress money, and you put into your account, that could raise some questions that you may not be able to answer if we aren't able to determine the paper trail of where it came from. So always discuss that with your lender first.
Well, thank you for that, Richard. And thank you for tuning in and listening to how you can purchase a home without selling your current home. So Richard and I are available. The contact information is up on the screen right now. Please reach out to us. We'd be happy to discuss your individual situation and help you kind of take those next steps in terms of getting everything lined up. And we would be happy to speak with you at any time. Thank you so much.
Thanks so much.